I think most people just listen via audio
Oh
anyways.
yeah, that's all right. Yeah.
Yeah, so and then, when it's all said and done, I'll send you the link
Yeah.
or whatever, and you can do your thing and we can review it, and if you're cool with it, yeah, happy to just edit out any not safe for work commentary, though. I don't know. I haven't had any instances of that, so I think it should probably be all right.
It should be all right. I've done one of these before. This is my second interview, so the first time I'm like, what am I getting myself into? Second time it's like, okay, you know what? How bad can it be?
This is, I mean,
It'll be fun.
I just like it to be more casual and it can kind of
Yeah.
go wherever the conversation wants to go. I mean, some of the stuff we talked about last time I thought was really fascinating. So one of the things I want to talk about is like your story and um, just around the food and like how you guys built that business. I thought that
Yeah.
was just a really fascinating thing. So we could go into
Sure.
that, and then
Sure.
I think maybe a little bit of your background and how you got to where you are now, and
Sure.
um, just sort of, and then I think one of the other things that might be interesting is because you're sort of so deep in the finance industry or have been for a long time, just your perspective on everything from maybe a personal or professional basis,
Yeah.
macro, micro, whatever, economy, globally. Like, is it all just a bunch of fear? And it's really
No,
like,
I've got some opinions on. I mean, there's many ways to, and there's been some people have been far, far, far more successful than me. There's many ways to get to heaven, but I have an approach which, you can only do what you know, right? And
yeah,
happy to talk about that. And I think there is a lot of fear mongering and a lot of short termism, which doesn't help people. Um,
yeah.
doesn't help
Well,
most people. Some people are very good at it. Yeah, I'm
yeah,
happy to talk,
yeah,
give you my views on that.
it's like create fear to create opportunity and then profit from it. It's yeah.
I think
So
you and I are
it
aligned in many ways on that from our previous conversation on some philosophies. So
yeah. Well, maybe we end on that one. So, I mean, I think it'd be cool, like, hear some of your origin story if we want to just sort of
yeah,
warm up that way. And, part of that you can delve into just your operator side of the business and how you grew up in it and working with your family in that perspective. It's a super interesting story, and the
sure.
growth
Yeah.
mode that you guys figured out too is interesting. So, yeah, fire away, man.
All right, man.
And Happy
Thanks
New
for having me
Year.
on. Happy New Year. Happy New
Yeah.
Year, and thanks for inviting me. It's nice to be here. And yeah, so I started. I studied chemistry at Oxford, out of all places, and the
Okay.
reason I studied chemistry is because I enjoyed it at high school because I was a bit of a nerd and had no idea what I was going to do next. But the nice thing about the UK is you don't have to choose that. You know, there isn't necessarily correlation between what you study and what you go into. So I did chemistry and then realized, oh my God, this is pretty hard. There's no way I'm going to go full time into science. I better find something to do. And I went into investment banking and really just because I thought it was fascinating. Um, these young guys being thrown in front of CFOs and CEOs of you know multi-billion-dollar public companies. I mean, with the boss and all that, and you're supposed to present these sort of big mergers of clashing together two large companies, which affects mass amounts of money, jobs, the future of these industries, and all of that. I thought that was incredible. I want a taste of that, and of course, in real life, it's working late nights and weekends, crunching numbers on an Excel spreadsheet for your
Yeah.
boss. That's what really happens when you first start. But look, I got taken to a few meetings, and over time was even able to speak in a few of the meetings, and that's just an incredible introduction to finance and how some parts of the financial world work. Right, I was very fortunate to have that. Did that for 5 years. I sort of looked around and I realized that it was great to do that, but it's not what I want to do forever. One of the deals I did was this American entrepreneur in Russia who did this TV business, and he built like a significant business on his own, and I really gelled with that guy. We were doing like a valuation sort of project for him, and I thought, wow, that's something that I can really aspire to one day. So I went off to Wharton, had a great time there, and then after that, said, okay, now what am I going to do? Well, I said, I'll go work with my dad. My dad had managed the Abu Dhabi royal family's real estate portfolio in the UK for a few years. It was about £1 billion portfolio at the time, so real estate asset management. And I thought, you know what, this is an opportunity to try and learn how he does things. And his work with the Abu Dhabi family had ended by the time I joined, and he'd started investing in his own account. So we did some interesting projects, basically investing in high quality real estate in London. And then 2007-8 happened, and we were just very lucky in that we had a couple of really good buildings with really good tenants. So even though the world was kind of crashing down, our tenants kept paying us rent, and interest rates went down. So our cash flows went up. Yeah. We weren't able to buy more properties because the bank shut down. And even though we had a relationship with banks for decades,
Yeah.
they were like, "I'm sorry, there's no money, liquidity now to buy stuff," and that would have been a golden opportunity to,
Oh yeah.
you know, really make a dent. But it is what it is. Can't we're very fortunate. But that was an important lesson. Buy good quality assets with good quality tenants, have good quality financing in place, and even when the world goes crazy, you're okay. The
Yeah.
thing is, it's not mark to market, unlike the stock market, right? So, had it been a public company or a REIT, we'd have seen the value of our holdings demolished. But because it's private and no one can, it's not on
Yeah.
a screen somewhere, all we saw was the cash flow. So
Yeah.
it was interesting, right?
At the end of the day, it's like cash is king anyways, right? And
Cash is
I
king.
mean, the only
Cash is
one
king.
that had money anyways was Buffett. So, I mean, he just went straight into Goldman and he got some sweetheart deals there, but yeah, that's pretty amazing that you guys kind of came out unscathed and just that's really it at the end of the day. It's like how much stress and worry do you want in your
Yeah,
gut,
yeah. Oh, look,
you
it was
know?
stressful. I'm painting the rosy side of the picture where we can't. Okay, of course we're stressed. And we didn't know if the bank was going to call us at some point and call in the loan, and they didn't because they saw the quality of the cash flow. So I won't
Yeah.
pretend it wasn't stressful, but it was in the great scheme of things, it was pretty good. Oh, well, if you want, we can go back to that your comment about Buffett because that's actually a huge part of how I invest in the stock market. Actually, is those kind of lessons. So it's
Oh
funny you
yeah.
bring it up. So yeah, yeah.
Yeah, we'll go back to like
Yeah, yeah,
fundamentals.
yeah.
Yeah, we'll get into that.
Look, again, the downside was I was in my whatever early 30s, mid I can't remember now, and there wasn't all that much for me to do. But we had this business in the Caribbean because we had the property with cash flowing, but there was nothing to buy because everything shut down. But we had this business in the Caribbean with a couple other families, and so I got shipped off there, and that was kind of like part two of my sort of education of my dad in terms of this is how you run a business or we had managers in place. This was a slight larger business. We had with some employees and managers and a whole team. So I went in, you could call it one of three directors slash owners in the business, um, and that was a supermarket business that my father and his um, um, partners had bought some years previously. It had been loss making with the previous owners, but it sat on 64 acres of land. And my dad, being a real estate guy, said, "Okay, I can actually do something with the real estate there." And his partners said, "Okay, we'll take care of the operating side of the business." Hired in a phenomenal manager in the beginning, and the real trick he did was he managed to work out the logistics of getting fresh produce in a timely manner to a small Caribbean island, so that once it was presented on the shelves, it was fresher than everyone else's strawberries, lettuce, all that sort of thing. Obviously, that attracts clients. Obviously, once that attracts clients, you can generate more cash flow. We're back to the cash flow thing again. Well, with that, we had a couple of partners who'd come from big uh, large public sort of CFO for a large public company, and kind of had a lot of business acumen, and he said, "Look, we can use these cash flows to enhance the team, build up a whole accounting team, upgrade the management, upgrade the facilities." My dad was involved with, okay, this is part of the facility upgrade and stuff using his real estate background. And so it kind of became this, virtuous flywheel where the better we managed the business, the more cash flow we got, the more we were able to operate the business, the more we were able to get better employees. And, we kind of grew to a 70 million revenue business over time. And then we use those cash flows to invest in real estate. And we use that real estate to enhance you know, the 64 acres of land we had, and it became like a hub in this is a very small country, but it became like a relatively big business in a small country. But it goes back to Warren Buffett's definition of does your business have a moat, which is a competitive advantage. And yeah, we had scale economics. We were doing, I mean, there's no official statistics, but call it 80% of the food retail and wholesale in this small country, the Turks and Caicos Islands. And so we had purchasing power, and shipping costs were low. And so, we were able to build out a business. And I got involved with some of the logistics because we had an inventory team that was no good at price, telling us our inventory levels and pricing. And I complained to the partners about it, and they said, "Oh, okay, smart Alec, why don't you go and fix it?" So I landed myself a project.
Yep.
And that took about 6 months, and it turned out actually really what it was about getting our IT guys, who were brilliant IT guys, but just focused on the IT side of things, with our line managers who were old school, like, food retailing guys, to actually speak together, and getting the guys at the warehouse at the back to follow processes and procedures to get all the stuff in and catalog it properly, account for spillage, breakage, that kind of thing. Because it's like any other model, like my Excel models when I was a banker, garbage in, garbage out. And we'd spent about $1 million on the software and implementing it, and it couldn't give us reliable results. And that just made me very upset. I said, how can we manage a business this way? So my project, that was probably my main contribution to this business, was getting that up and running. And by that time we'd grown, and we'd hired a different set of managers, because the managers we had at the start of the business were phenomenal. For that part, we kind of felt, or the partners felt, we needed someone else to take it to the next step, where we'd have multi-locations, stuff like that. In the beginning, the manager was managing the business, looked very well, but he'd look at the number of chicken bones at the back of the in the garbage, and get a very good sense, because he's been in the business for many years, of how the meat department was doing, for example. Obviously, as you grow, you need to get some of the analytics and the processes in, and we just needed a couple of people who are more used to managing that way. Very grateful for the first guy for, as I mentioned, getting that logistics in place. Very grateful for the later managers for enabling us to actually expand locations and stuff. And that's where, that flywheel really starts to take off, because, as you know, compounding isn't a straight line. It's a exponential line. And that was kind of my introduction to having a kind of holding company, and having a really good cash flowing business, and using that cash flow to reinvest at reasonable rates of return into ancillary businesses, and kind of grow the pot. And very honestly, I just feel very fortunate to have been, played a role in it, but also been allowed to come into this. And it's one thing to read it in the textbooks, and it's another thing to actually be there on the coalface of the thing, and experience it. My brother and I started a side business, which was a waste management recycling business, which is still operating in the country. We're very proud to actually introduce recycling, because it's a beautiful country, beaches, and beautiful water and all of that, and the waste management apparatus was severely lacking, which is an unfortunate thing to have in such a beautiful location. So we built that business up, started recycling. It didn't quite get the scale of the food services and food wholesale business. So it was a very interesting thing, seeing how you operate a small business without competitive advantages versus operating a business with competitive advantages. And just, how one thing seems much more easy, and the other thing is like you just struggle, and you're running just to stay in one place. So that really drilled into me again, this idea of competitive advantage and how important that is, which kind of leads on to okay, this is why I got very interested in reading about Warren Buffett's investment style because, he goes on and on about high returns invested capital, competitive advantage, high returns invested capital, competitive advantage. And that kind of resonated a lot, having experienced both sides of that.
Yeah. Yeah, it's super. I mean, it's so interesting that because I kind of had a similar, you start with the Excel and then you go into operator role. And it's so much more interesting at the end of that after a couple decades where now you're putting that financial model together and you go, and that assumption doesn't quite meet real world, or like this is way more difficult in practice, and you end up making the model better based on some of the dynamics from like the learnings from operating. And so I think having both of it in real time to be able to like have the conversation back and forth in your brain is like it's I think that is a competitive advantage as well, because you can plan and operate, and that flywheel kind of takes over too, which is cool. And then on the Buffett thing, yeah, like I grew up pretty close to Omaha, and so like everybody knew about it. And I've even seen one of my friends' dads like stand up at one of the meetings and like ask a question, which is kind of funny. So
That's fantastic. Yeah.
I've watched all his videos and stuff over the years. But there was one I just came across yesterday. And yeah, I mean, it's the same stuff over and over again. It's like markets beat managers 10 days out of 10, and it's so true. He was like, I saw one yesterday where he's like, oh yeah, I spent $400 million on a shoe company, which seemed to be doing really well. They had great cash flow. They were, no competition. And I bought it in stock. And he's like, I made one mistake. The business went out. Well, he's like, the business went out of business. And so my 400 million in stock went to zero. And today, whenever it was recorded, the Berkshire stock would have been worth 5 billion. So that hurts a bit. But then he said the thing he forgot to realize was shoes weren't going to be made in America anymore. They're going to be made overseas. And that was like the one thing that screwed the business up. And it's like the blind spots that you don't even see, regardless of how well you operate, it's, and that's just sort of a cost structure thing and figuring out how you get it manufactured cheaper, better. So yeah, it's all there. I mean, how did you get into the Buffett mindset? Because there's so many different philosophies, right?
Yeah, yes. So I'll tell you just on that Buffett thing you mentioned, it's one of the nice things about it. It just gives you when you had someone like Warren Buffett's track record, right? I mean, what at his stage, what's there left to really talk about? It's like, oh, these are the mistakes I made.
Yeah.
Right? It's like, but it shows you the way the guy thinks. He thinks of things probabilistically, and he thinks of things in terms of opportunity cost. Right? Everything for him is an opportunity cost of capital. Had I invested that 400 million, had I invested in a different way, what would have happened? And that opportunity cost way of thinking about it, and that probabilistic way of is a real key learning, I think, in terms of anyone trying to follow a little bit of what he does. Plus what you just said, the crystallizing everything or synthesizing everything down to like the key points. You can do all this analysis, but these are the 1, 2, 3, 4, 5 factors that make override everything else. So I mean, hard to do in practice. So what got me into him was the following realization. When we sold everything around 2012, 13, the business and the real estate and all of that, and we kind of went into cash. And I said, well, what are we going to do now? Right. Yeah. I first started, okay, let me go and try and buy a couple of private small businesses and that private equity style thing, which I've come from. And I'd sort of invest a little bit in the markets while searching for companies. And then it didn't take long for me to say, I'm just going to focus full time on the equity markets. One, I was trained in finance, but two is I realized that we had this holding company, like I mentioned before, where we took the cash flows from the real estate business, I beg your pardon, from the food services business and reinvested into real estate. And the other thing we did is we had, high quality real estate with good tenants and good locations. So a version of competitive advantage where we could build up a real estate portfolio that way. And I said, those are interesting. There's a lot of public holding companies out there who do similar things. But the one thing these large, giant, multi-billion-dollar public holding companies can do that we couldn't do because we're much smaller was this idea of synthetic leverage. And it all came from this paper I read by this quant fund called AQR. They wrote about 10 years ago plus, more than 10 years ago. But they said, look, if you look at Warren Buffett, the secret to his success is twofold. The first is he's a phenomenal investor, no doubt. He picks high quality companies, sticks with them, all the things everyone knows. And this is kind of an open secret, but less people focused on it, was this idea of using insurance float to significantly and in a low risk way juice his returns by effectively using cheap non-recourse leverage.
Yeah.
Now, of course, Warren Buffett goes on and say, leverage, derivatives, all these things are weapons of mass destruction. Don't use leverage. Never do that. It'll kill you. And he's right, except that he's used leverage his whole career. but the but is everything here.
Yeah.
He's used cheap non-recourse. You can't get margin called on this leverage, and that is night and day. The difference between when most people go and get margin loans and what Warren Buffett does. And he did it through taking insurance float. So every year you pay in your insurance premiums to Geico and all the other insurance businesses. And every year Geico and all the insurance businesses pay out their claims for accidents and all sorts. But between paying out the claims and receiving the premium, there's like billions of dollars just sitting there. I think he's referred to as a revolving door of cash that just sits there. And he can invest it on behalf of Berkshire Hathaway and its shareholders. And because, I don't know about you, but I've never been able to go and say, give me back my insurance premium. You can't do that, right?
Right, yeah.
So what he realized was, as long as he doesn't lose the money, right, it doesn't matter how volatile his investments are. So the stock price could go up and down 40%. But as long as he hasn't invested in, excuse my language, crappy businesses that could go to zero, he can sit back and be pretty relaxed. And what this paper analyzed, they said basically Warren Buffett's 60 year or 40 year, whatever, the time they analyzed, he made 15% a year, which is phenomenal compounding. But with this leverage, he went to the low 20s. And that's the difference between being your run-of-the-mill billionaire and I made 500 billion, 80 billion myself, billionaire like Warren Buffett. It's all in the synthetic leverage through a holding company. And he discusses the advantages of holding companies in his 2014, I think it was annual letter, and he has a phenomenal 2-3 pages on the advantages of holding companies. Coming from a much more modest holding company background myself, I could, that spoke to me. I said, okay, are there other companies like Warren Buffett, maybe slightly, or Berkshire Hathaway earlier in their career, which have this concept of synthetic leverage that I can maybe not use leverage myself, but invest in these handful of companies that follow this similar ethos, and that's kind of the backbone of my strategy. It's basically investing in smart billionaires who figured it out and riding along with them.
I feel like I want to call this episode "Run of the Mill Billionaire."
There you go.
Because it's so, but look, though, you're right. It's like, how far can we stay ahead of the reaper? And it's like interest rate arbitrage. It's like, if I can bring in cash and make a return that's higher than my risk level, then I get that difference as, quote, income to me. So the thing that got me with the insurance float, because I started my career as an actuary, and it was like, you either go the life insurance or the insurance route, or you go the pension route. And I went the pension route, but I was familiar with all of that stuff. And it seems to me the one thing that Buffett and Munger lose sleep over is that one black swan major catastrophe event. And it's one of the reasons they hold so much cash on the balance sheet. It isn't because, downturn 1, 2, 3, 4. It's like, but the flip side of that is, if everything blows up, like if we get hit by a meteor, no one cares about the stock market.
Yes,
so
that's true.
So it's like, on some level, like everything stops working. And so you just have to be prepared. Like, what is it before that level? So all the underwriters and actuaries and risk modelers and all of that. Because it's like risk, real risk is the thing that you don't see coming, is the blind spot. So it's like, okay, if you're searching for blind spots your whole life, can you find them all? Or is there one you can't find? Which is like, that's really the risk in the Berkshire equation. And then I think it's Ted, the new portfolio manager, who's taken over more and more of the trading. Like, the guy is a monster,
Yeah,
like an
that's
absolute monster. I saw something where he put like 70K or 70 million into his IRA and turned it into
yes.
like 500 million, or it's, I mean, the numbers are just ridiculous. Like, it doesn't make sense.
That was
But
unfortunate. I think it was one of these media outlets that were trying to, name and shame people, and and he responded back and said, at the time when I first did this, he was not earning a he was earning a very reasonable, modest salary. Didn't come from a special background or anything like that, and he basically made it himself through very wise long-term investing, um, through tools available to just about everyone. He had no
yeah,
special treatment, and I guess he felt forced to write this because he's like, look, I mean, if you're going to try and shame me for just being a regular, well, a genius, but a regular guy, then I'm going to answer you, and power to him. But
yeah.
it sets a model for the rest of us. Like if we try and follow that, that's what you could do in theory.
Well, I love the approach. So how difficult has it been for you to go out and find, because it's not like FactSet or Bloomberg Terminals has like a Buffett button, like using synthetic leverage based on this paper. Like,
Yeah, yeah,
that's a lot of time, energy, and you really have to unpack a lot of businesses. And sort of I mean, I saw this thing recently where it's like, the problem today isn't finding businesses, it's filtering them. Where back in Buffett's early days, it was like I had to go to this weird library and pull out 10Ks. And so you just had information asymmetry, but now it's just the mountain of noise. So how
yeah.
do you, and I mean, that also seems like why someone would come to you as their investment advisor or portfolio manager and be like, look, I know where all these secret hidden doors are, and I know how to find this stuff, and I spend all my time thinking about it and unpacking it. But like, how do you go from I read this paper to, okay, now I'm implementing this and I feel some level of confidence north of 50-50 at the slot machine kind of thing? Like, how do you link those two together and operationalize
It's a
it?
great question, actually. I think that there's multiple elements here. I'm just trying to think how to sort this through in a cohesive, so I don't ramble at you.
Yeah, yeah,
Um,
yeah.
the first thing is going back to earlier part of the conversation that I'm a bit of a nerd and I kind of enjoy this. I
Yeah,
enjoy studying these things. When we sold the business, I was thinking, what am I going to do for a while? I think at one point my wife was frustrated and he says, I mean, you're kind of like a professor. You just like analyzing things. And I'm like, actually, you're right. I do,
yeah,
and
yeah, yeah.
that's, so let me focus on that. So this is a very hard job if you don't like analyzing and reading things because it's just
Mhm.
tedious otherwise. But if you're curious about the world, you're curious about business models, you're curious about you know, curious about money. I don't mean curious about money in terms of like, hey, I just want to get rich, but curious about how does business work? What have people done in the past to make things? What are mistakes they've made? You can learn. You have that curious mindset about it, and you're happy to just grab a bunch of paper and spend your day sort of reading those sorts of things.
Yeah.
This is a phenomenal business, right? Because you get to do that all day. And when you do that, you sort of come across things, and I think um, one of the best things I've found is this idea of crowdsourcing. Um, Everyone talks about this. If you're a professional money manager, a lot of professional allocators, like, well, what's your point of differentiation? How do you get what's the word? I forgot. Unique ideas that no one else has thought of. And
Right.
my view is no one has unique ideas. I mean, very few people have unique ideas anymore, right? Even Charlie Munger talks about whatever you've thought about, someone else has thought about before. So read a lot. Um, just like any company you come across, someone's written about it. Even an obscure microcap, there's something called the microcap club, where you put in the microcap and you'll more than likely you find somebody somewhere's done a write up on it. So instead of trying to find something no one's thought of before, I like to invert and do it the other way, where I say there are all these very clever fund managers who write open letters to investors and prospective investors, telling about, ideas they've got. And why don't you use that as a first pass filtering mechanism?
Yeah.
If a fund manager who's a professional investor has gone and written about something and put their money behind it, they obviously think it's a good idea.
Right.
Look, it's very important to not just blindly copy and have them completely influence your point of view. You have to know what you're looking for.
Mm-hmm.
But that takes there's, I don't know, 10,000 companies. How do I get that to 30 companies I'm going to look at as a first pass? And how do I narrow that down to 5 companies I'm going to do, actually, because time is precious. Opportunity cost of time and capital. How am I going to, whittle that down to 5 companies, 3 companies I'm going to really spend time on?
Mm-hmm.
And I find that's a really good way of doing it. Like I say, having this overlay of I'm a Warren Buffett style adherent where I want high quality companies with high return on invested capital that would run by intelligent and honest and capable managers. That's a very good start. So that helps you whittle out a vast majority of these things. And then having this idea of synthetic leverage on top of that helps you whittle it further. So it becomes a fairly efficient process for finding things to spend time on. The other thing is about being a long-term investor, I like to hold things 5, 10 years if I can more, is I don't have to find an idea every week. If I find 2 really good ideas in a year, that's kind of all you need, frankly. The difficulty, and I think why people come to me potentially, is one is few people have the inclination to do what I'm doing, spending that much time. But 2, it's also to have the mental, the behavioral characteristics, which I think is very important to be able to sit on your hands and do nothing because you think you've got good companies, even if you're underperforming for a period of time, even if the world's going a little bit crazy in a period of time, because you've studied what you own, you know what you own, you have a thesis. The thesis hasn't been broken, it just takes time to play out. And not panic sell or panic buy because of FOMO or all that sort of thing. And I think that's huge. That's a huge part of that. And sometimes it looks like I'm not doing anything. It's just like behind the scenes, I'm reading, analyzing and stuff. There's just not much buying and selling going on.
Yeah.
So those are I hope I answered your question in terms of how that works.
Yeah, and I have 2 follow-ups. One is, how do you know when to sell? One was like the duration or hold period. You kind of answered that. But the other point that just sort of like connected for me as you were talking was, and this is sort of built into the Buffett mantra of value-based buying, but the fact that you were in that real estate business during 2008, during the real estate market crash, what happened was your portfolio didn't change overnight, just the market's expectation. So the market price, as you said, you were private, so it didn't really matter, but like the market price went down by, I don't know, pick your number, half, whatever. But you were still cash flowing from one day to the next, probably pretty consistently. I mean, maybe that there was a little volatility in there, but it wasn't at the same level as the market price went down. So, I think that is temperament. I think that stuff sort of trains you. And obviously in the investor mindset, you can't be emotional about it. I mean, if your time horizon's 10 years, you're looking at different sorts of things for when you get out, rather than just, oh, Mr. Market knocked on my door today and everything's on sale. So I guess the main question then is like, how do you decide to sell? Is it back to this opportunity cost of capital thing where you see a better possibility and you just want to shift that potential future return? Or how do you decide to get out of an equity?
I think it was a Phil Fisher who, Warren Buffett says is his, he learned a lot from reading his stuff. I think he gave 3 reasons to sell. You made a mistake, the thesis has changed, I believe, or there's a opportunity cost is a better opportunity.
Mm-hmm.
He may have said something slightly different, but those are the 3 I use, right?
Yeah.
I made a mistake. I had a thesis on something and it went down. Okay, the stock price went down significantly. Now it's one of 2 things. Either I buy more because I like it at a cheaper price, and I didn't, blow all my capital in one go. I bought, a half position and it went down so I can really load up and be comfortable. Hard to do emotionally, but sometimes, I've done it if I felt confident it was a good company. Or no, it went down because, you know, I made a mistake. I was wrong in my thesis. It's a very interesting game investing because on the one hand, you have to have the arrogance to think you can beat the market. Otherwise, just invest in the S&P.
Right.
On the other hand, you have to have the humility to know that you make mistakes all the time, and it's this holding both thoughts in your head at the same time is difficult in practice. So it's like reassess what happened. Why did it happen? Is this a short-term temporary thing? Or is it, no, the fundamental characteristics of the business is not what I thought? In that case, you sell and you take your loss. The only advantage you get there is maybe it's a tax write-off, a tax loss selling a little bit. Blunts, that thought blunts the blow a little bit, but it's still painful. And that's happened to me more times than I care to remember, right? The other one is opportunity cost is a difficult one because you're taking a company you've owned for a long time, you've made money on. Hopefully, you've done well on it if you've owned it for a long time and your thesis was right, so you're not going to pay capital gains tax on it.
Yeah.
And then you're re-risking onto a new situation. So I think you got to be very careful about how you do that, right? Because you're literally paying away a large chunk of change on something very familiar to you in taxes to start a new level of risk on something new. So, obviously, it has to happen at some point. You have to refresh some parts of the portfolio at some point. New ideas come along. But it's one to be careful about. And then thesis change. Like this was good company. The dynamics had changed. Going back to your Warren Buffett shoe thing, probably was a good business, but the world changed. Everything shoes were being made, internationally.
Right.
Well, that changes the business. So that kind of thing. Okay.
There's this thing I go back and forth on, especially being in the startup world, because here's my thesis from an operational side. As an operator, design your business to be as agile as possible so you extract maximum profits or cash flow from the market as it exists today, because it feels like we've almost fundamental shifted our global marketplace into a world where more disruptions are happening more often, and in order to maintain the pole position or competitive advantage, it's the organizations that are designed to change on a dime and be agile enough to respond faster than competitors. But then I marry that against, that's easy when you're early stage, but when you're Apple, you can't change the fact that you make computers for different use cases. And the use case might change from I wear something on my wrist for health reasons versus I type on a sheet of glass all day for work reasons versus coming up next, I put something in front of my eyes, or even after that, I drive around in a smart car computer, right? So right. The question is like, and Apple's maintained that agility from, iPod to iPad to iPhone, and everybody knows that whole story. So I kind of go back and forth on this, is like, when you design a business to capture the maximum amount of this cash flow or profit, and I've had this conversation with the head of strategy at a big fintech person, used to work at Google, and then some other folks as well. And like the Origin of Wealth book, where you think about like the topology is this constantly moving wave, where the peaks on the waves are the profit centers, and they only exist for a short period of time. Case in point, e-commerce during a pandemic, short-lived, but a lot of companies overinvested that we see now because they thought that's new normal. Instead of approaching it as this is yet another new thing that we need to capture, but we don't assume it's going to last forever. And so I guess my question to you is, as you've done all this research and looked at these companies with good fundamentals are working towards this compounding effect, have you seen management and discussion and analysis, or maybe organizations that have been designed to be as agile as possible, or do they say, here's our North Star, we make food, and then we will just continue to iterate along whatever dimensions are required by the market? Do you see that? Do you have a thesis on any of this?
It's not like not like a formal thesis, but hearing you speak, when you mentioned Apple, you mentioned Google. I mean, if it's okay with you, I'll talk about Amazon, right?
Yeah,
Because
yeah, yeah.
Amazon's familiar to people. It's a holding in my portfolio. It's a phenomenal company. It's been hit like the rest of the market recently, but that's, it goes back to your question, what do you do if the thing goes down? Do you think you made a mistake or not? And I don't think so for a number of reasons. But long story short, I think Amazon is the exemplar of this phenomenal management team who have a very competitively advantaged, strong business, but who stay ahead of the curve or up to date with the curve. And I like your analogy about the policy keeps changing. Um, Jeff Bezos is famous for saying it's always day one, right? And I was just actually reading this analysis on them, and someone saying like Amazon can be thought of as the world's largest startup because even though it's just this behemoth large company, Jeff Bezos talked about all the operating teams of two pizza teams.
Yeah, right.
The teams are only large enough that can be supported by two pizza lunch or something like that. So they're small teams, and each of them is being very entrepreneurial, doing their thing. And if you look at how this has manifested in the company, they started off selling DVDs and books, right? Or books and DVDs. Now they're the everything store. And then they grew into, well, every technology we use for ourselves, why don't we productize that and open it up to the world? So, well, we're developing all this amount of servers and stuff. Well, probably the rest of the world needs servers, and AWS was created, and they literally invented, in a meaningful way, this idea of the cloud, right? And what it started as a need they had, which they thought, okay, we could productize that and open up to the world. They had need for fulfillment. Well, they built their own fulfillment. Then they started charging for fulfillment. Every retailer needs to, have advertise for slotting fees and stuff. Well, they started an advertising business. Every single time they've had a need, or the market has changed, or there's been some change in the e-commerce landscape, they've adapted to it, they've been ahead of it, they've created a whole sub-industry, and they've productized it and sold it for extra profit to people. And I think it's all been done essentially because of this day one mindset. So I'd hold them up as as one of the banner companies in terms of what you're referring to.
Yeah, it makes sense. And I'm familiar with it too. I've got a bunch of friends who work there. I mean, they have 1.5 million people, so everybody knows somebody that works at Amazon these days. It's funny that compared to like Costco, and Munger's described it as the Lollapalooza effect, and Walmart getting more into digital. I've got some friends over there as well. And it's so interesting to see, you're selling groceries and food, but there's totally different mindsets and strategies and models in each one. And then you go to like Dollar General from Walmart, which is like a different strategy, which is I'm going to go into markets that are smaller than Walmart can handle and capture all of it. And then I even think about, I was talking to one startup founder who's making like automated dark stores. And it's like, now you can go into markets that are even smaller than Dollar General can handle. And you just pick up your bodega stuff. People from New York would get that reference. Pick up your bodega stuff from, the gas station out of a, very large vending machine, quote unquote. So,
well, Amazon's been trialing that with their, I forgot what they call it, with their supermarket, their small format supermarket. So I don't know how successful that's been, but yeah, look, it's I think it's very interesting.
They've got so much stuff. I don't know how you manage all of it. Like their 200 people team. I mean, Andy Jassy's got his work cut out for him. Like Bezos was like, "All right, buddy, like it's on you now. Like I'm gonna go hang out for a minute." Yeah, I did about a 25-year stint, so I'm gonna go take a breather for a minute.
I think Jassy, from what I mean, I just third hand reading public materials and stuff, sounds like he's very focused now on the profitability of the
Yeah,
various units and stuff, which I think, is important
have
for
to.
phase two, as it were, for
Yeah,
business. Yeah.
have to. So we've got, I don't know, maybe 10 minutes left.
Sure.
So I want to hear like two things. One, I usually like to end this stuff with like where's your head at? It could be anything. Like where's your head at? Your most evergreen thinking in terms of approach to life, approach to market, approach to business, could be anything. And then at the very end, I just, for people who want to get in touch with you, talk more about this stuff, potentially get
Yeah.
engaged, where do they go? How do they find you? Obviously, I'll link out to your stuff at the end of the episode, but um, yeah, that's a big one. Like where is your head at these days? Like what's the output? Because you have so many inputs. What's the like, I feel like maybe this has legs. Could be anything. You tell me.
I think it goes a little bit back to our discussion a few minutes ago about these companies being agile and they have a good platform, but sort of staying ahead of what's going on in the world. And even Munger and Buffett say the same thing, that I think the way I approach think it's such a general thing, is always be learning. Always be learning, always be iterating, always be improving. You've got to know what you're good at, what you're bad at, but try and get up a little bit smarter or go to bed a little bit smarter every day. And it's funny. I've got two young kids, and it's 7 and 3. And my 7-year-old, we have chats once in a while, and I keep telling her it's okay to make mistakes as long as you try and as long as you learn from them, and as long as they're not catastrophic mistakes. But she's too young to understand that part. But you know, I'll give you an idea. Like I'm trying to learn to play the guitar, and I'm terrible at playing the guitar. Just 40-something-year-old who's trying to come up with a hobby.
Yeah.
But I just practice 15, 20 minutes a day, and I've been doing it for about a year, and I can actually hold a semi-decent tune now. But if you looked at me, 6 months ago, it's like, oh my goodness, this is terrible. But I guess I've always approached things with the idea of I'm a quick study. I believe I'm a quick study, not because I'm smart anymore, but because I have this attitude that
Yes.
I'm a quick study.
Yes.
And that's kind of what I'm trying to impart on my daughter, which is you've got to approach new things with this open attitude that I'm not going to learn everything, but the 80-20 rule. 20% of a topic gives you 80% of the major understanding about it. And of course, then it takes years and years to become an expert. But just to get started, you just need to know a few basic things. To learn to play the guitar, you need to learn 5 or 6 chords and play them reasonably well. And then you can actually hold a beginner tune pretty easily. You can play around the fireplace, so to speak, and it won't sound terrible. And it's that attitude towards stocks, towards learning about new companies, towards learning a new skill. I think that's, and if you keep doing that knowledge and that compounds, and if you keep forgiving yourself mistakes, because God knows I make so many all the time, and keep that open attitude, I think that's where my head is at. You kind of need it when you're having a family, because the families are so dynamic, and that's the only way to just uh, progress through things. And I think you need it as a stock picker, and you need it as an investment manager, because the world keeps changing.
Yeah.
I don't know, I hope that answered your question.
No, I
I
love
felt,
that. I love that. Always be learning and stay open and don't beat yourself up too much. I mean, it's like that old adage, those who say they can't and those who say they do, they're both right. And it's
right,
just that
right.
mindset and that approach. Like I I would math always sort of came easy to me. And I just remember everyone saying, like, I can't do math. And like math is so hard. And I'm like, well, yeah, with that perspective. But like if the teachers were like, math's not that bad. Let me just show you a couple tricks and it's more about problem solving. Hey, there you go. But I think you're right about like the learning and the older you get and having a family, it just humbles you in so many different ways and your
That's very
mistakes
true.
where you're just like, you've seen that chart where it's like early on in your life, you're like, I know everything. And then you're
Yes.
like, I don't know anything. And then
Nothing.
at some point, you're like, I know maybe one thing, maybe,
Yeah.
and that's about it.
Yeah. That's so true.
Yeah. Yeah. So I love that. I had another guest on and hers was patience. And I like that combination of like patience, always be learning, be open, I feel like those things will help so many people just live a better life, personal, professional, whatever. So I love that. So yeah, last bit is like, where can folks find you online, website, whatever, reach out to you? What's the best way to
Sure,
get
yeah,
in
that's very
touch with
kind of you.
you? And
My website is alphyncap, alphyncap.com.
okay,
And there's my contact information there and some of my investor letters and um, that kind of thing. I'm also on Twitter. It's just my name at Samer Hakoura, SamerHakoura. So yeah,
great. I love it. And then I'll if you don't mind, I'll also link out to your LinkedIn if you want and your website in the
sure,
show
yeah,
notes. And then yeah, folks can just reach out to you, talk shop, and do some cool work together maybe in the future. That'd be
yeah.
great.
I love talking shop with people. I love talking investments, stocks, all that kind of thing. It's it's actually fun to me. So anyone wants to talk about that, you're more than welcome. Please contact me.
Labor of love, man. That's fascination will get you everywhere in life. And yeah, the road between expert and novice is just keep going.
Just keep going.
Just
Yeah,
keep going.
forgive yourself your mistakes.
Yeah,
That's
that's
the other
right.
one. Yeah.
We're all human and none of us are perfect. So that's it. Great. Well, Samara, this has been wonderful. Thanks so much. I'm glad we were able to get together uh, today, and looking forward to a bright new year for you and your family. And I'm bullish on 2023 from a variety of perspectives, even though the media is a bit dark-minded these days. But I just see so much opportunity and light and joy in the world that it's hard not to be. So I'm
I'm
just
with you on
grateful
that.
for you taking a little time and us being able to chat again. And I love your story. It's phenomenal. I think there's very few people like you who have operated, invested, have stayed in the game, study Buffett, real estate, food, Amazon. I mean, you're just like right there in the core needs of humanity at a global scale. So I think it's great, man. Keep doing what you're doing and good things will happen.
I appreciate that. Thank you. Thank you so much for having me, Sean. It was fun speaking to you.
Yeah, great. All right. Well, have a great day and great weekend. And here's to a bright 2023.
Take care, man.
All right. Bye bye.